Okay, everyone, let's start with the next chapter, that is completion and review. Let's do a quick recap or revision of this chapter. Let's start this year. This is chapter number 7 of your CA Inter Audit syllabus. Let's start. In this, no, my dear students, we have in total 6 standards. Okay, we have SA 560, that is subsequent events, SA 570, that is going concern, SA 580, that is written representation, SA 260, that is communicating with those charged with governance, SA 265, that is deficiencies in internal control, and finally you have SA 450, which is evaluation of the misstatements. Okay, we have to master these 6 standards in this chapter. Let's go for it one by one. Let's do a quick, sprinty revision in this matter. Okay, let's start this year. We are now doing SA 560, that is called subsequent events. Okay, I want you all to understand everything nicely. Please see here, look here at the screen, see. If this is representing a financial year end, that is 31st March 2017 is the financial year end of course, the year 16-17, correct? The audit report date, the auditor is giving on 20th of August 2017, that is the audit report date. And the financial statement issue date is 10th of September 2017. Okay, so take it in this manner. Let's do one by one now. Hear me out. My dear students, in this case, suppose if on the balance sheet date, no, there is some condition which is existing. Condition existing on the balance sheet date. Now, what is the condition? Let's take an example. Let's say just before 31st of March, let's say somewhere here where I put the cross, on that day, a major debtor or a few major debtors who are, let's say, in the city of, let's say, Hyderabad, they could not pay. They are facing a lot of difficulty because there is some earthquake in Hyderabad, because of which they are in a very difficult situation to pay the amount. So on the balance sheet date, we know for sure that they are finding a lot of difficulty to pay the amount. So condition is existing on the balance sheet date. Condition is existing on the balance sheet date. Now, after the balance sheet date gets over, between the balance sheet date and the auditor's report date, so between balance sheet date and the auditor's report date on this day, between that, we get additional evidence regarding the condition that was existing. So look here, we get additional evidence regarding the condition that was existing. So we get AE regarding CE. So CE was existing on the balance sheet date, correct? Condition was existing on the balance sheet date. And we got additional evidence regarding the condition that was existing between the balance sheet date and the auditor's report date. Okay. What they are saying is this: if such a additional evidence we get, in that case, the management of the company, through their accounting department, they have to make adjustment in the financial statements. This is what you learn in AS4, that is events occurring after the balance sheet date. So what should the management do? Management, in the case of case 1, this is for us case 1, management should make adjustment of in the financial statements. Clear to understand this part here? Okay. Sir, what does adjustment look like? So I'll just give you an example, please here. Suppose debtors, the company was originally planning to show 10 crores debtors value, and 90% of debtors were there in Hyderabad and they were not in a position to pay the amount. So we received calls and emails from them after 31st of March, but till that additional evidence we got calls and messages from them that they will not be able to pay the amount. So what should the company do in this case? Company, as per AS4, they should take these as bad debts. So 90% debtors means 9 crores will be bad debts. And in the outer column, they should show only 1 crore as the debtor's value. This is called making adjustments in the financial statements. Making adjustment in the financial statements. Comfortable till here? Okay. Now, second thing. Let's go with another situation this year. Suppose, my dear students, on the balance sheet date, everything is very normal in the company. Very normal. No problem. Okay. So there is no condition existing on the balance sheet date. No condition is existing. Nothing major, no issues, no evidence, no proof of something that has gone majorly wrong. Nothing. Everything is going normal in the company. But between the balance sheet date that is 31st of March and the auditor's report date that is 20th of August, a new event arises in the company. A new event arises in the company. Let's say there was a major factory building fire that had taken place. So major fire in the factory building took place, and that happened on this day. Now on 31st of March, we didn't know that fire will happen, correct? But fire happened here. So you understand here that new event arose. So in that case, you understand, see, condition was not existing on the balance sheet date, and a new event arose between the balance sheet date and the auditor's report date. This is for us, we'll call it as case 2. Between you and me, we'll call it as case 2. Okay. So case 1 is what? When condition existed on the balance sheet date and we got additional evidence regarding the condition existing. That is case 1, in which the company has to make adjustment of in the financial statements. But case 2 is what? Condition was not existing on the balance sheet date and a new event arose between the balance sheet date and the auditor's report date. So in that case, the company should make a disclosure in the financial statements. Company should make a disclosure in the financial statements. Okay. Now, what disclosure they will show? So let's take an example here also. Please see here. Factory building caught fire. Earlier, they were showing the value as 50 crores. They will continue showing the same value. 50 crores will be the value. But they have to now add a notes to account. They have to add a note. So let's say they are adding something called as note number 41. Example I'm taking. Note number 41. So note number 1 is here, 2 is here, 3, 4, like that. Many notes will be there. Like that, here you have note number 41 in which they will have to give the disclosure. What will they give as a disclosure? They will say a major fire occurred in the factory building on, let's say, 11th of July. Okay. And because of the major fire, we are expecting a damage of around 50 crores worth of machines in the factory, or 50 crores worth of items which are there in the factory. And the building has also suffered heavy losses. We have filed an insurance claim with the insurance company, and we are expecting that the insurance company will give back 90% of the claim amount. Like that, a neat disclosure will be given. This the management of the company has to do in the case of case 2. Okay. So case 1, case 2, you have understood now. Tell me again, case 1 is what? Condition existing on the balance sheet date, and there is additional evidence regarding condition that is existing. In that case, you understand that the management of the company will make the adjustment in the financial statement. That is case 1. Case 2 is what? Condition is not existing on the balance sheet date. Everything is normal. But a new event arises between the balance sheet date and the auditor's report date, because of which the company has to make a disclosure in the financial statements. Are you there with me, yes or no? Simple to understand this. This is what is written in AS4. I have still not taught you the auditing part. This is AS4. Now, what should the auditor do in this case? The auditor should, in the case of case 1 and case 2, in which the management has given adjustment of or disclosure in, auditor procedures are common for both the cases. First, auditor will understand the procedure the management has adopted to identify the subsequent event. The auditor has to obtain an understanding of the procedures that the management has adopted to identify subsequent events. The auditor will read the minutes of meeting. See if a major fire has occurred in the factory or debtors are not paying a significant amount. Don't you think this will be discussed in the board of directors meeting? The answer is yes. So we'll be reading the minutes of meeting to get a better understanding of the situation. Okay. Next is reading the interim financial statements. The quarterly financial statements must have been released by the company. So you can see here that our audit report is made on 20th of August, correct? So don't you think that April month, May month, June month would have already happened, and then the company would have released their quarterly financial statements, correct? So the auditor will read the quarterly or the interim financial statements. Okay. And finally, you can inquire with the management regarding this matter. So with the brain, you will try to understand the procedure the management has adopted to identify subsequent events. With the eyes, you will read minutes of meeting, you will read the interim financial statements, and with the mouth you will inquire with the management. Very comfortable. This is one question. Very, very simple. Okay. Now let's go ahead with cases 3 and 4. What is 3 and 4? Understand very nicely. Look here. My dear students, case 1 and case 2 has already occurred. But the management of the company has not informed us. They have not told us regarding this situation. So they are keeping it hidden. So what happens is, because if it is case 1, they have not made the adjustments in the financial statements as recommended by AS4, or in the case of case 2, they have not given disclosure in the financial statements as required by AS4. They have not done that. So accounting wise, it is wrong. They are keeping it hidden. Now let's understand first of all the reason why they'll keep it hidden. Imagine if 90% of debtors are not paying the amount. If the company discloses that, then it means that company's sales, that is that debtors related, that sales which is there, even that will go down. It means the company, that bad debts will have a very big effect on the P&L account, yes or no? So you understand here that the company profit will be very low. And if the company discloses lower profit, then the market sentiment about the company will become slightly negative, correct? Yeah, imagine the second situation of case 2 where there was a fire in the factory building. Now, if the shareholder comes to know that a major fire has occurred in the factory building of the company, you only imagine the kind of market sentiments that will go ahead in relation to the company. It will be very negative. A company doesn't want that kind of negativity around the company, even though that is the truth about the company. But they are not giving the truthful image. So the management of the company has not made the adjustment or the disclosure in the financial statements. So because the management has not told about this at all, even though we do our procedures here, we also don't come to know about this matter. So what happens is, if we don't come to know about this matter, we also give the audit report in a very naive manner, correct? So we also feel that everything is good in the company. So we have given a audit report here. So audit report we have given. Now think about it. Financial statements are wrong. In that, many things were not given to us. So tell us, is our audit report wrong or right? It is also wrong only in one way. So now what happened is, the auditor comes to know about this situation here, somewhere here. That is, see, after he has given the audit report, but before the financial statements are issued to the shareholders. In that gap, if the auditor comes to know about the matter, in the language of the standard they have written, if the auditor becomes aware of situations in relation to case 1, case 2, that is, events have occurred between the balance sheet date and the auditor's report date, and the auditor becomes aware of it after the audit report is given, but before the financial statements have been issued, in that case, the auditor has to take some action, because he now knows that the financial statement of the company is wrong, because of which the audit report is also wrong. In that case, what they have said is, auditor will first of all discuss the matter with the management. Correct? The auditor will determine whether FS need any kind of amendment. And third, auditor will inquire how to address the matter. How is the management planning to address the matter? Discuss with the management regarding the situation. We'll tell them, why didn't you tell us about this? Determine whether FS require any kind of amendment. Ask them if FS needs any amendments or not before you issue the financial statements. And third, inquire how the management is planning to address this important situation. That is basically where we are. Are you there with me, yes or no? So you understand that this is what the auditor will do in the case of case 3. But there are more things to be done in case 3, but these are the, I'm going to write CP here. I hope you understand. CP basically means these are the common points in the case of case 3, case 4. So discuss with the management, determine whether FS need any kind of amendment, and inquire with the management how to address. These are the common points for case 3 as well as case 4. Okay. Now let's do the uncommon points here. What are the uncommon points? Let's see one by one, please here. Look at the screen, please here. Auditor should carry out the audit procedures if the management agrees to the amendment. So the management agrees that yes, they will change the financial statements. So let's say they change the financial statement, let's say by this date, which I'm marking in maroon color, okay? then the auditor will carry out the audit procedures. He'll carry out the audit procedures. That is exactly what is given here also. Auditor will extend the audit procedures to the new audit report date. Auditor will extend the audit procedures to the new audit report date, new report date. Okay. And auditor will provide the new audit report. Auditor will provide the new audit report. These 3 points that you see here are the uncommon points for uncommon points. It is only for case 3. So case 3 has these 3 common points, as I told you: discuss, determine, inquire, how to address, and the 3 uncommon points, which is carry out the audit procedures, extend the audit procedures to the new report date, and provide the new report. Are you there with me? Yes or no? Okay, simple. And when the auditor provides a new report, he has 2 options. If the changes are a little bit, not that much, then the auditor will provide the new audit report with an additional date. Simply, he will take the old audit report, add a new additional date there, and whatever are the new evidence that he got in this period, see in this period, that he will simply add there. Correct? No, he'll simply give his views on that there. If there are, suppose there are major changes, there are a lot of things that the management had hidden it from us. Here, suppose I told you that debtors are not going to pay us the amount, fire in the factory building. These are only 2 situations. Suppose in this case, we come to know that there were around 25 situations here that they did not inform us. Lot of situations were there. In that case, the changes in the audit report will be so major that the auditor will prefer giving a new audit report, including a EOM or an OM paragraph. As you know very well, EOM paragraph is given as a disclosure in relation to the financial statements, but it is to tell the shareholders that please go and read this particular note to account regarding financial statements. And OM paragraph is regarding the auditor's responsibilities and auditor's report. Are you there with me? Yes or no? Comfortable till here? Okay. That is basically what will happen in the case of case 3. Let's do case 4 now. Case 4 similar to case 3, but with a major twist. What is similar to case 3? Let's discuss that. Case 1, case 2 has happened in the company. Okay. Management has not made the adjustment or they have not disclosed. So tell me, is the financial statement correct or incorrect? It is incorrect. So the auditor was very, naive person. So auditor also gave the audit report. And auditor in this case, tell me, is audit report is correct or incorrect? It is incorrect. Correct. You understand here, audit report is not correct. Simple. But the auditor comes to know about this fact that lot of situations had occurred between the lot of case 1, case 2 related matters have occurred between the balance sheet date and the auditor's report date. And the auditor came to know about this matter somewhere here. Imagine here means what? See, after the financial statements have been issued. After the financial statements have been issued, the auditor comes to know. Auditor will do what? He will first discuss with the management, determine whether FS need any kind of amendment, and inquire with the management how to address. I told you these are common points for both case 3 and case 4. To discuss with the management, determine whether FS require any amendment, and inquire with the management how to address. Now, what will the auditor do? The next points which are there now are similar to what we saw. So, if the management here corrects the financial statement, it's a good thing. So, auditor will carry out the audit procedures. He will extend the audit procedures to the new audit report date, correct? And he'll provide the new audit report, exactly the same point which we saw here. See, exactly the same points. All these things the auditor will do. But because it is known to the auditor after the financial statements have been issued, I hope you understand the gravity of the situation. It means that the shareholders have already received the audited financial statements along with the auditor's report, and they are going through it and making investments in the company. And that is when we come to know. It's a very difficult situation. So the auditor will specifically see one more situation, one more thing, that whether steps are being taken by the management to inform the shareholders or the users of the financial statements. Is the management taking care? Are they taking steps? Are they telling the people by giving a small ad in the newspaper saying that please don't rely on our audited financial statements issued on so and so date. In another 1 month, we'll be releasing new financial statement along with a new audit report. Is the management giving that information to the shareholders? That is what we are checking. steps taken by the management to inform the users of the financial statements. Simple. And to give more clarity on the matter, the auditor may provide EOM or OM paragraph along with the reasons. Very, very comfortable, easy, simple. So that is the procedure of the auditor in the case of case 4. Okay. Now, a tough situation I'm going to put you in. Imagine this. Suppose management steps taken by the management to inform, management doesn't take these steps. I put a star here, star I've repeated here. See, management doesn't take these steps. They have an attitude where they say, so what, shareholders are facing some loss in the market. Every day people are suffering loss in the market. So let it be our shareholders this time. It's okay. We are not going to take any special steps here. That is a very bad attitude to have, correct? So you understand the problem here. It means that the management is not ready to correct their mistake. So we will gently notify the management or the TCWG of the company that, see, you have done a mistake, please correct it. Still if they don't take, see, no steps taken, still if they don't do anything, then the auditor will try to disassociate himself from the client. See, what is happening is finance statements are incorrect. Because of that, audit report has also become incorrect. So if the shareholders come to know about the truth, you will understand that the management reputation will go down. With that, the CA firm auditor's reputation will also go down. So auditor wants to ensure that, see, we have told them to change it, still they are not changing it. So let the auditor will try to tell the world that he is correct, and he will tell the people, the users of the finance statements, that don't rely on the auditor's report. Don't rely on the auditor's report. That is not the right report that we have given. Okay, so see this. Auditor shall seek to prevent reliance on his audit report. Seek to prevent reliance on his audit report. Seek to prevent reliance. Telling the people, don't read our audit report. It is not the correct one. That is what the auditor will do. Are you there with me? Yes or no? Comfortable? That is basically SA 560. Easy to understand this area. Okay. Can we go ahead now?